All right, if we could settle down for just a second. You suffer through a few words from me, and then we'll all have dinner. And more drinks. And dancing afterwards. You can't hear me? Really? Okay. Now you can hear me. Welcome, everybody. 2017. What a big year it has been. A big year of growth. Growth for our portfolios. Growth for our firm. Your favorite financial planning firm is growing by leaps and bounds. And it's our whole community continues to grow. You see people here, you see the crowd here, gets bigger every year. We are grateful for your continued trust and confidence in us. It really makes a world of difference, and we try to always reward that as much as we can. If you haven't seen it, we expanded our headquarters in Safety Harbor, and if you haven't seen it, you really should come by and look. It's quite a bit of a different look. We have some pictures for that. It is a lot more modern. For those of you who've been around for years and years and remember the days we were on the radio show, one of the things that we didn't count on when we stopped doing the radio show caused all of the planners and the planners in the firm to talk to each other for 2 or 3 hours every day and really synchronize our message. And after the radio show, we kind of all went back into our offices and didn't stay quite as synchronized. So we had a chance, and we met some really neat people from Valpak, and some of them are here tonight. And we toured their offices, and we loved their offices. We got to meet their architects, and we had them come in and interview everybody in the firm. And said, what would you like it to be like? And it turns out none of us wanted to have offices anymore. So you'll see in the other pictures that we don't have offices. We all work together in a collaborative fashion. The office is very, very efficient. It's a fun place to be. A funny thing happened along the way. We had a big break room. It ended up looking oddly like a wine bar. I don't know how that happened exactly, but there it is. If you haven't had a chance to see it yet, I can tell you this. Every third Friday of the month, all year long, Safety Harbor has a street festival. And so we've decided to have just a happy hour at our break room every third Friday. You're welcome to come on and just have a glass of wine or beer, whatever you'd like, and then enjoy the festival. So, open invitation. Generally speaking, we're going to start that about 6 p.m. So I imagine somebody will be there before that, so some of us may not leave. So. Along with the expansion, I want to talk to you about your Rogan and Associates team. We're up to 15 employees now, and if everybody who's one of the employees could stand up, I'd appreciate it for a second. And if all goes well, it will be at least 17 by the end of next year, maybe more. Another thing that we have done, we've entered into an agreement with a company to provide us access to office space and meeting rooms in every major city in America. Because, as I said, we're thrilled and grateful for your confidence and your trust in us. Some of you have friends and family and relatives and colleagues in other cities, and maybe you've been a little reluctant to give us a referral. So we're changing that. We're going to be able to meet with them, and we're not going to go to their homes or anything like that. We're going to meet with them in offices that we have access to wherever they are. We'll start the process. And I say this because I know that the number of referrals we've been getting has been increasing. So as a way to help you with that, we'll have a phone interview, a teleconference interview is available, and if they feel some value, we will fly out and meet with them in the office nearest them. So that's starting up. Now, the biggest question is, why are we expanding? What's going on? I'm going to have some slides I want to show you what's going on, because this is year 32 in the business for me, and I don't think I've ever been as excited as I am for the future. The slide, so this slide right here, and it's at the top of it's cut off a little bit, that's okay. Sir John Templeton, decades ago, was known to say that an upmarket is born on pessimism, it grows on skepticism, it matures on optimism, and it will die on euphoria. And that chart there has a few more adjectives along the way, but you know, when everybody's excited, everybody likes being in the stock market, and the market goes up. And then when everybody who could ever be able to convince to be into the market buys in, it's the point of peak popularity. It's the best time for everybody to be happy about it, but there's really no one left to get in. And then invariably it starts to come back down again during the cycle. So the next slide will show you. I actually did the next slide. That's about the last 20 years or so, and I put the little skepticism, optimism markers on there. You go back to the mid-90s, and everybody, actually that goes back, now I'm thinking about 30 years. So that's the early to mid-90s on the left there, and people were pretty skeptical. You may not remember that, 92, 94, people were not very excited about things. In the second half of that decade, things really accelerated. People got optimistic all the way to 2000, when the dot-com boom was peaking, and people were darn euphoric. People were quitting their jobs, becoming day traders. They knew it was sure you'd always make money in the stock market. There was no one left to get in. It was more expensive than it had ever been in history, and everybody loved it. Well, what followed then was the dot-com boom busted. We had that little terrorist attack thing in 2001. Then we had the bottom of the market was reached when Enron and WorldCom and Adelphia and some corporate malfeasance happened. And really the first part of the bottom happened when we passed Sarbanes-Oxley, the government's answer to make sure we'd never have a financial crisis again. Anyway, then we climbed back up over the next 5 years. People started to be a little skeptical, and then the housing market was going, real estate was going very well, and we got to be optimistic. I'm not so sure in 2007 we were euphoric, but pretty happy with things. And that was when the financial crisis hit. And then we had about, in 15 months, the most bizarre, erratic response from our government ever. At the point, at the end of it, where nobody understood the rules because they were making the rules up on napkins at that point. The market went down, everybody got out. This is kind of a very important point. Everybody you know got out. Virtually every individual investor, mom, pa, every household was out. Institutions were out. Pension funds, hedge fund managers were out. Now, since then, the market's gone up quite a bit. But ask yourself this, do you know anybody who's optimistic right now? Besides us. Seriously, besides us. Are your friends who are not our clients talking about how exciting they are, how excited they are for our country and the economy? They're not. People are very pessimistic. This is good news. This is good. They're not in, as the next slide will show you. I pondered how it was that we could be at an all-time high. I mean, I kind of already knew, because we track these things. Households weren't in, individuals were not in. Institutions have been very busy creating magical investments that are blowing up right and left. All those smart guys, the endowment fund managers, the Ivy League endowments that are managing it, just blowing up right and left. Hedge funds blowing up right and left. So if you look at the gray line, if you can see the gray line, that's households. This thing starts at the bottom of the market in 2009, where we know everybody had gotten out. They started to come back in a little bit, and then they started to get back out again. They were scared. By 2013, they were hearing that little tiny Greece was going to be that domino that toppled the world. Greece, we were there this past summer, with the entire country's economic output slightly less than Detroit. By the way, Detroit did file bankruptcy. They didn't threaten to. Sean and Grand Rapids didn't notice. The rest of the state didn't notice, didn't topple the Western world. But that got them out. They started to go, well, maybe that's not going to happen. They got back in a little bit, and they got out. So what we know from the bottom of the market, individuals who had gotten out in droves are slightly more out today than they were then. This is important. The orange line, you can see the bottom line there. Those are the smart guys. The hedge funds, the institutional money managers, the endowment money managers, the pension money managers. They got out and have consistently sold more and more and more. And today they're out more than they've been in my lifetime, pretty much. Now, why is that important? Because the two sets of investors that could get into the stock market and then turn around and panic and get back out are out. They are not in. So how did we get to an all-time high without them? The answer is the green line. Corporations, for a long time now, at a record pace, have been buying back their own stock, which couldn't be better for us, the long-term buy and hold investor. They're buying back their stock, and there's virtually no supply of sellers because nobody's in. So they're creating demand, causing prices to go up. At the same time, they're retiring that stock, and they're reducing supply. A corporation can't turn around and panic like an individual or an institution and sell it tomorrow. They'd have to file an offering with the SEC. This is stock that's not coming back out. So here we are at record highs, and not record high valuations, by the way. This is really, really important because all the hedge fund guys who have missed this entire rally are very upset, and they're doing anything they can to plant articles every day about why the market has to crash because they need an entry point. They've missed it. The index has tripled while they've been out, and they're desperate to try to get in. The problem they're having is there's no one left to scare out. They're already out. So it's kind of a fascinating time. We're barely above average in valuation in the stock market. Corporations' profits are growing at a record pace. Corporations' profit levels are higher than they've ever been. Even around the world, corporate balance sheets are very, very healthy. This is kind of important because we don't buy countries. We buy companies, and they're all very healthy right now. So I can't promise anything, and certainly our regulators would be upset if I did, but I can't fathom a major market decline coming anytime soon. I'd have to wonder who was there to sell. So, and more importantly, what's the alternative? So this slide, and it's a little hard to read, I'll tell you what it's showing you there. It's showing you interest rates in our country since John F. Kennedy was president. It's showing you specifically the 10-year Treasury's yield since JFK was president. Most every fixed income security will move in lockstep with the 10-year Treasury bond. So if you see all the way on the left there, it's 1963, the yield was 4%. And it started to go up all the way to 1981 when it peaked at 16%. Now, since then, it has steadily declined. There's a couple of very important things about that. It's 2.3 today, 2.3%. That also means that unless you think interest rates are going to continue to go lower forever, if you think they're going to go up at all, like at all, then you don't have any adult memory of how fixed income securities behave when interest rates rise. You'd have to be in your mid to late 70s and have owned bonds in your late 20s and remember how they worked back then and forgot how they've worked ever since to know what's coming. And this is kind of a very important point. Part of the reason your allocations and your portfolios are the way they are is because things have to make sense to us. There's a lot of people that have these, the book says this is what you're supposed to do ideas. We can't live with that. It has to make sense. We have to have a plan for you going forward. Fixed income securities over the next 10 years or so, I'm fairly convinced, they're not going to plummet like a short-term correction could be in the stock market. They're not going to go down 20%. But they're probably going to have a negative overall rate of return for the next 10 years, even if it's only -1. People, the book says you allocate to fixed income securities for safety. It's not safety, it's lack of volatility. Here's a good example of what people tend to think how you're supposed to allocate your money. And there might have been maybe a couple of decades in the past that this could have worked. But I'm telling you, it cannot work today. And people, I was having a conversation with a regulator year ago, 2 years ago, I don't remember now. The FINRA people sent us our normal auditors, and the older guy was born 4 years after I got licensed. I wish I was making a joke about that. And he said to me, "You've got a lot of people in the stock market in their retirement portfolios. Isn't that risky?" I said, "Well, the market's at an all-time high, so what's it risky against?" He said, "Well, they could lose money." Well, the market's at an all-time high, so those are always temporary. And he said, "Well, you should have, a lot of their money in fixed income." I said, "Do you know why that is?" He goes, "It's safer." I go, "Safer against what?" I mean, right now we're at 30-year, 50-year, 60-year low interest rates. It's safer against making them money? The reality is, I said to him, people use those allocations because the only people that can't be trusted when the market is on sale briefly is individual investors. Every market decline in our lifetime has been temporary. It always is temporary. But every time it goes down, every time stock prices go on sale temporarily, the media comes up and tells you it's the end of the world as you've known it. This has never happened before. It's unprecedented. It'll never come back ever. Now, they're wrong every time. They have to be wrong every time. The only reason in the past you might have put fixed income securities into a portfolio is to reduce volatility so you didn't panic and sell while they were temporarily on sale. That is the only reason that allocation idea exists, period. I was having a conversation with somebody recently, I don't remember who, and they said, "Well, I called this guy from a famous investment firm on the website, and he said, 'That's crazy. You're almost ready to retire. You should have 2/3 of your money in fixed income.'" Now, the guy on the other end of the phone was probably 25, and he read it somewhere. No one ever asked him why. But look at this idea for a second. So if you're between 20 and 35, I'm supposed to put a fifth of your money into something that's going to lose you money over the next 10 years. That seems kind of mean. If you're 36 to 50, I'm supposed to put a third of your money into something that's going to lose you money. If you're my age, I'm supposed to put almost 2/3 of your money into something that's going to lose me money. I'm not going to do that. And by gosh, if you're retired, I'm supposed to put almost all of your money into something that's going to lose you money. I'm not going to do that. We have to have a plan. It has to make sense. Our blog is called Why We Plan because we always have to answer why. And if that means the next time the market goes on sale, we have to squeeze your hand a little tighter and say, it's going to be okay, we're going to do that. But I actually think we're in the early years of what they call a secular bull market. We're in the early years of a period of time that, if history repeats, would be 15, 16, 17 year of above average rates of return. Let me give you a quick history lesson and I'll move on because it's too much, a little bit. Every time people hate stocks, it's a great time to be in. Every time everybody loves stocks, you should be worried a little bit. Kind of basic. In 1950, people hated stocks. You could get, if you put $100,000 into a 10-year treasury, you got $3,000 a year of interest, and you were guaranteed by 1960 to get your $100,000 back. That's it. But you could have put $100,000 in the S&P, got $5,000 in dividends, and in a normal 10-year period of time, that $5,000 a year would become $8,000 a year. And in a normal 10-year period of time, by 1960, the $100,000 would be $200,000. You got to have a lot of pessimism to go, I don't want more income today, I want no chance to grow my money, and no chance to grow my income. But that's where we were. So what happened? From 1950 to 1968, 15% a year in the market. Well above average. By 1968, everybody was in. They loved it. They were sure it couldn't go any lower ever again. So the market, by that point, was more expensive than any time since the Depression. Since actually before the Depression. Anyway. So we then 15 years where the only return came from dividends, about 5% a year. By 1982, everybody hated stocks again. Everybody was all out. No, by the way, 10-year treasury yielded 14%. Who needed stocks? So everybody was out. Next 18 years, 19% a year from 82 to 2000, and there were hiccups along the way. But by 2000, everybody was in. They loved stocks. In 3 months' time, we'll have gone 18 years at 5% a year on the S&P. You don't follow up long periods of half the normal return with periods of less than normal return. It's not how you regress to the mean. So a couple of things that are going on here that's pretty interesting. They have this book somewhere that I've never seen, but everybody seems to know about it, that says I'm supposed to put your money into something that's going to lose your money. And it's exactly at a time when I think we're going to have above average returns for the next several years. Not going to do it. We're going to figure out a way to keep you confident. We'll tell you things like when we put a portfolio together, you become an owner of 800 of the world's biggest corporations. Can't really understand how that's risky. 800 corporations that did $20 trillion in revenue last year in every country in the world, employed tens of millions of people. The terrorist attack on 9/11, you know what all those employees did on 9/12? They went to work. It's organic. It has to happen. The people that tell you the stock market is risky, the only risk at all is any overreaction to the media screaming at you when it goes on sale. That's the only risk. So we had a good year this year. We're going to continue to have a very good year, several years coming forward here. We're expanding. We're making these facilities available because I've been in this business a long time. And when we get through these periods of time, again, grateful and thankful for your confidence, what will happen is you're going to like us even more. And you're going to have a lot of other friends, and even the family members you don't like, you're going to go, you got to talk to these guys. And so we need to gear up to have people ready to talk to your friends and your family. And that's what we're doing. A couple of other things important. We talked about why we plan. We have revamped our website. We've revamped the way we get you our message. This is very important because there's more to this story. And we find when people don't come and talk to us for 2 or 3 years at a time, we are your inoculation to misinformation. Every day you're being bombarded with absolutely wrong misinformation. So if you avoid coming in to see your planner once a year, which you should not do, we're doing a few things here. We have this blog. You go to our website, and it's right up there. You can sign up right there. Every time we post anything, it'll go in your email. We have a newsletter once a quarter. Aaron is heading that for us. And the newsletter is something you can also sign up with, and it's not just about the markets. It's about what's going on with your favorite financial planning firm also, and some of the other things that we're doing. We're also going to start a series of workshops, something we have done in the past, educational workshops where we could tell this whole story in maybe 30 or 40 minutes and do a Q&A. When we were back on the radio, we used to have people that came to see us, but sometimes after listening to us for weeks or months, or in some cases, they listened to us for years before they came and talked to us. They knew what they were going to hear. When we just get a referral, one time somebody said, I came to see you because my friend who's your client said you made him a lot of money last year. It's not exactly our value proposition. So these workshops will give people an indoctrination into why we plan, what we do that's planning that's different than somebody else they may know who just sold them an investment product. Because there has to be a why, there has to be a reason, there has to be a plan. So we invite you to do that. They'll be probably here, they'll be at some other hotels around somewhere near you. We'll try to spread out the locations a little bit. Feel free to come, we'll have refreshments. We're not, the old joke on the radio, we're not feeding you free chicken dinners, just to come talk to us. But it's going to be a mechanism where you can bring and funnel your friends you want to introduce to us, so a very low-risk way for them to understand who we are. And with that in mind, come to the first one, get your inoculation to the misinformation. The second or third or fourth one, we'd like you to bring a friend as your sort of admission ticket. You guys are already doing it anyway, so here's a way just to funnel it through. Also, we are doing a lot of work with our Facebook page, and if you're not on Facebook, that's fine. If you are, we give a lot of information on Facebook. So go to our page. like the page, but also click follow. Facebook has a funny thing that goes on. You can like a page and never see anything that happens. We're sending some things out. I don't know what it is, 600 or 700 people that like the page, which is not great since we have 900 families as clients. Okay, I should talk to each other. But we'd send something out, and it would reach 100 people. That's a Facebook thing. So go to the page if you're on it, hit follow, and you'll see the information we're sending out there. All right, so that's about all I had tonight. The dinner is about to be served. We listened to everybody from last year, and it's a plated dinner, so stay where you are. Dinner's coming to you. Don't forget, there's a photo booth over there. They've got an amazing array of things, get some great memory photos. And finally, we want you to get out after dinner and come out and dance. Thank you all. I'm looking forward to a great 2018.